today for our first virtual SALT meeting. We were very excited and happy and motivated to hear that you all still wanted to continue even in this virtual format. I think that's sort of where we are. It's going to be our new normal for at least the near future. So we appreciate that and appreciate our sponsors who were willing and able to come together for this panel today. I know that the impact of the CARES Act is something that's very important for our states, for our members, for our sponsors. So we wanted to be as timely as we could with respect to that and get the information out there. Joining us today, of course, are our sponsors. We've got about 85 other folks, members and other fiscal leaders from across our 50 states. Jackson Brainerd, of course, from our Denver office is also with us today. And Jocelyn, of course, working behind the scenes from our DC office. So we thank them for their help in advance. Let's go to the next slide, please. Thank you. So again, here's the agenda for today. So we're going to go through three panel discussions here. The first, as you can see, is the federal stimulus and relief measures. Next, we will have a discussion on state tax conformity to the CARES Act provisions. And then finally, impact of the CARES Act on state tax commissions. And we will take Q&A at the end. Jocelyn's going to be using the chat function. So if you wouldn't mind putting your questions in or typing them into the chat box for us to consolidate and then ask at the end, that would be fantastic. She's going to mute all of your speakers for now. So please do communicate with us via the chat box if at all possible. And then that's it for now. And again, thank you so much for joining us. I know it's been very strange for all of us to get used to this. I personally wasn't set up for virtual living, so it's been a little bit of a challenge for me as well, but we just have to pivot and adapt. And in some ways, I feel like this format is actually enabling us to reach more people. So your insight, your expertise, your analysis and research actually will be able to reach more people and be of more benefit to a lot more of our state leaders than perhaps could have been in more of our in-person settings. So I think that maybe is a positive result out of all that's happening now. But again, we appreciate your enthusiasm and your ability and your willingness to keep moving forward. We do plan on still continuing to reinvigorate the SALT task force and the links with the Fiscal Leaders Program. So we are still going to be moving full steam ahead in that respect and use this as a way to sort of regroup and refocus. With that, I'm going to turn it over to Representative Abney, who is on the phone here. And sir, if you wouldn't mind.
Okay, I hope everybody can hear me. John, Michael, give me a thumbs up if you can hear me. That's just a test. Okay, gotcha, buddy. I appreciate that. Thanks much, everybody. I'm sorry that my system here is not working. I've been on these things all day, and unfortunately, I've got to be on one in the next hour, like most of you are. And so I think between my wife and her duties and mine, we've got the computer messed up. So I'll try and get on as we go. But thank you so much for taking the time out of your day. And I know we're in a lot of different time zones. But first of all, I hope everyone is safe. We are in uncharted waters, and this could not have come at a better timely manner than it is now. Because I know most of you, like myself, are involved in trying to figure out what's happening with the coronavirus and our tax systems. Right now, in almost all jurisdictions I know of, people are struggling with how is this affecting state taxes, how is it affecting local taxes, school board, a number of things. So this is truly important. And I do want to thank Linda and her staff. They always do such a great job. This hopefully will give us a broad view, a macro view of state and local taxes and the procedures that we need to take a look at. The value of this, and I really thank the sponsors for keeping this going, is that it allows us as a group of people to take a look at what's happening, not just in our jurisdictions, but across the country, and get great ideas about how to approach problems. And also, I do know that the ideas that we get from different portions of the country may seem weird to us depending on where we come from, but NCSL does a great job of lobbying Congress to make sure that our voices are heard. I know that that happens, and so I'm really grateful for that. I'm also grateful for working with John. We had a conversation earlier this morning, and he's a good guy out there, Green Bay area, and he's going to do a great job. But this is going to be great to help us get some data to support the ideas that we have to balance out budgets. I know a lot of you are chairs of Ways and Means Committee, like I'm chair of the Finance Committee. We do taxes and appropriations. So this gives us a broad view and a bigger perspective of how to handle this in our own territory. So I'm looking forward to the discussion that we're going to have. And it looks like we've got about 90 people online, which is a good thing. Unfortunately, I may have to leave in the middle of this. I've got to be online with the governor pretty soon. But Arlinda is going to do a great job, I know. So welcome aboard. And my guy, John, I know he's got a couple of comments that he wants to make too. So John, you're on, bro.
Hey, thanks, Marvin. I appreciate it. And I would just echo all of those same things. And I just want to thank Arturo and Erlinda and Jackson and the whole NCSL team, and particularly the sponsors that are still continuing to support us. For those of you that don't know, I'm honored to be filling the position for Representative Julie Stokes as she's going through her issues, and we just pray for her all the time and hope that she gets better. And so, and I also hope that you nominate me for the next session in my own session, but I'm proud to be filling in for Julie right now. And working with Marvin, so he's been very, very kind to loop me in. I think like all of you, we're looking, we got into this as kind of an extension of our stewardship obligation. We built several companies throughout Wisconsin and Tennessee and Florida. And rather than sitting on the sofa, just like many of you, you decide, you know what, if something's going to happen, I need to get down there and do that. So we're serving for a few years, and hopefully we can move that forward. But I said back in March, being in finance, I think that the risk that we have here, and the thing that I've learned from all of this is to not say, yeah, but this time it's different. That's going to be our biggest risk, is if we say, yeah, but this time it's different. Yeah, the boogeyman is different, but it's not any different from 1974 when we had the oil embargo and we had gas on every other day. And it's not any different than 12% interest rates for home mortgages during the late 70s. And it's not any different than Black Monday in 1984. When the stock market crashed 22% in a single day, and it's certainly not any different than 9/11. And so I think we do ourselves a disservice by betting against the country and betting against good old-fashioned Yankee ingenuity. So I'm very, very optimistic, and I look at what is happening here in Wisconsin and some of the states that I have a lot of exposure to. And I too am looking forward to the various different views that everybody has. Like Marvin said, we had some conversation where what their house is doing and what we're doing here in Wisconsin. Certainly we can talk to Kurt and find out what they're doing in Utah. And I think that's a phenomenal process. But I think what's neat about all of this, Erlinda, and I'm excited, is that it's rejuvenating the SALT task force in budget and revenue. SALT was originally just put together to deal with the Quill and the Wayfair decision, and through Kurt and Deb Peters' leadership and others, we were able to successfully do that. I think now we get a chance to move forward and see, and it's my hope that this committee gets stronger and better, that we find issues that are germane to all of the problems that we're looking at. And I think if you go back to the early 80s, Joel Barker wrote a book. He's kind of the father of paradigm shifts. And when a paradigm shifts, everything goes back to zero. And so I think there's an opportunity for us to reset, to start taking a look at those things. And let's use Maslow also if we're using that time frame. And we get to, instead of the self-actualization, we get to be down. What are the basic fundamental things that we need to be doing and delivering here in our state and in all the other states? And I think this committee will be able to play a strong role in creating best practices, being a clearinghouse and a resource for not just us, but for the whole body of NCSL teams, and then to enhance the tools and logistics that we use to interface with all of those folks. So I think the next couple of years are going to be very exciting for this committee, and I think also for those that are aware. So anyway, thanks for having me.
Thank you very much. Appreciate the comments from our co-chairs, and again, we're just excited to be moving forward and gathering everybody in this virtual environment. So we're motivated. All right, so now we're going to start with our first panelist, Scott Roberti from Ernst & Young. Sir, if you want to take the floor, we're ready.
Great. Thank you, Erlinda, and welcome everybody. You know, I hope in these historic times everyone is doing well. So my task here over the next about 15 minutes is really to sort of frame out the relief and stimulus measures that we've seen come out of Congress and the federal government. And then Carl and Rich are going to sort of dig deeper into those tax provisions. So we can move on to the first content slide. Keep going. There we go. So if we sort of look at this, you know, from a macro point of view, we're going to spend most of our time on the CARES Act, which is bill number 3. But really, Congress started, you know, earlier on with 2 prior bills that focused on, you know, providing additional funding for vaccine development, supporting R&D in this area, back funding the CDC. And then in bill number 2 came in and really with the Families First Act tried to provide additional funding around paid family leave, family and medical leave, and really trying to provide that apparatus to support, you know, people going through this pandemic and so forth. Really where we get to sort of the meat and potatoes around relief and stimulus is when Congress came back in late March and enacted the CARES Act, which provided, you know, a number of provisions to further stimulate the economy, deal with, I think we're up to, and this is just an unfortunate statistics, 1 in 6 Americans that are out of work, providing funding for them. Providing funding for, you know, business sectors that were significantly impacted by the government shutdowns that we've seen across many of the states and so forth. And this CARES Act was refunded again, and we'll talk a bit more about this on April 24th, so a few weeks ago. So if we move down to the next slide, let's start peeling this back a little bit because we're talking about close to $3 trillion. Of stimulus and relief measures that we've seen the federal government put in place. So this slide here sort of breaks it into, you know, 3 areas. You know, direct aid for unemployment insurance. We've seen some aid to the state. This is clearly a topic that will likely get a lot of attention for a potential 4th bill. If we sort of look at unemployment insurance, as I just stated, we have about 1 in 6 Americans out of work. This provides $600 per week, sort of an increase in benefits for up to 4 months. If states repeal what they call the waiting week, so there's typically provisions prior to workers getting unemployment benefits, the federal government will fund an additional 13 weeks of benefit through the end of 2020 after workers have run out of state unemployment benefits. Federal funding for UI benefits for those not usually eligible. Think about self-employed individuals, independent contractors, those with limited work history. Those are all covered under this provision. Sort of an interesting issue that is sort of something to think about later on is what happens to employers' experience rating. So in typical times of recession, state exhausts their unemployment funds. They borrow from the federal government to prop that back up, and then look to businesses, especially those with a history of you know, having employee layoffs to pay higher unemployment insurance to the state. So this is obviously, you know, while we've seen recessions in the past, you know, this is more of a forced economic shutdown. So, you know, where do we go and how are those employer experiences looked at a later date? We've also seen a number of loans to business programs, which I'll talk about a little bit later on. And then some of the tax provisions around modifications to the Tax Cuts and Jobs Act, which we all know was passed in December of 2017, and a new employer retention credit, both of which, you know, I'll go through the employer retention credit in a little bit more detail, and then Carl and Richard will get into the modifications to TCJA. So let's dig into this a little bit more. We can move down onto the next slide, Jocelyn. Actually, you took this out of order. Can you go back? I apologize. So I'm looking at the slide. Can you go to the slide that says individual tax relief? Let's walk through those first. Should be one more. Nope. Must not have made it into the deck. So let me pull down the provisions and talk a bit more about, and I'll break this into sort of individual, then we'll look at the business side. So on the individual side, the main item here is a new refundable tax credit. We saw a similar structure with regard to rebates in the 2008 Great Recession. This is not considered taxable income, or let me rephrase this. Since it's not considered taxable income, it's therefore refundable. Taxpayers who do not have a tax liability will actually receive this money. So you don't have to have a tax liability to receive money. It's $1,200 for individuals and up to $2,400 for couples, additional $500 for every dependent child. And this phases out beginning at $75,000 for individuals and $150,000 for couples. With regard to employers, there's a delay in paying a portion of the Social Security tax, with 50% being due at the end of 2021, and another 50% due at the end of 2022. And sort of in the interim, the Social Security Trust Fund will be backfilled through the general fund that Congress has. The TCJA provisions, we saw a number of changes here. And I know Carl will dig a little bit deeper into these. Some of them were focused on getting cash into the hands of taxpayers. Others were focused on making some technical changes. Jocelyn, if we can go to the employee retention credit slide. Apologize, my slides are a little messed up. So go one more. Yep, let's go here. Yep, perfect, thank you. So the employee retention credit is a refundable credit, and it's available to all businesses that have not received a loan through the Small Business Administrations under the Paycheck Protection Program. And it's available to any business that has full or partial suspension of operations due to any sort of work from home, business closure orders at the state level, or any business that's lost 50% or more of its gross receipts as compared to the same quarter last year. It's a credit equal to 50% of wages paid, and this includes healthcare costs paid by the employer to maintain any sort of group healthcare plan, and this is capped at $10,000 per employee for this year, for 2020. Those businesses, and it includes exempt organizations with less than 100 employees, it applies to all wages. For businesses or tax exempt organizations with greater than 100 employees, it applies only to the wages paid to employees that aren't currently working. Just based on experience from my firm, we've been working with many companies to avail themselves of these types of credits. The application process is a bit cumbersome, but once we sort of get through it, the funding has been coming through. We can move on to the Paycheck Protection Program, Jocelyn. There we go. Thank you. So this is administered through the Small Business Administration. This is the program that had run out of funds and then was reestablished with the sort of Bill 3.5, which was passed on April 27th. So this is eligible businesses or with 500 or fewer employees. It's intended to cover payroll expenses and debt obligations for a 2-month period, up to $10 million per business. This loan is forgiven for federal tax purposes if it's used for payroll, mortgage, rent, and utilities. And I know Richard's going to touch on this a bit more, especially with regard to the state considerations of this forgiveness element of the program, which is critical because we still haven't received guidance yet at the federal level with regard to this. And it's something I think from a state perspective, you all should be aware of. Sort of move on. In addition, I put this next slide in on economic stabilization. Not this slide, but so let me just talk about sort of in addition to some of the tax credits we've seen the federal government provide additional measures through the U.S. Treasury Exchange Stabilization Fund, which is provided or earmarked monies for companies that are deemed critical to the United States national security. And there's also elements of this where funding is provided to states and cities. Congress, you probably saw a lot of interesting, let's say back and forth with regard to providing funding. So if you go back to 2008, what were these funds used for? And therefore we saw Congress place a number of restrictions on the types of funds and what those funds could be used for i.e., no stock buybacks, limitations on CEO pay, et cetera. And there's also oversight with regard to this program through the Congressional Oversight Commission and then the Special Inspector General. So, and then we've seen, more funding, through the SBA check program as indicated. Let me just wrap up here. Jocelyn, I'm down on your last slide, the last two slides with regard to state fiscal challenges. And just briefly talk about, and I know some of this will be part of future webcasts, but, our modeling and modeling of a number of other organizations is starting, to point towards, significant revenue reductions within the states. If you think about sales tax and any sort of gasoline excise taxes are down significantly. It's just an unfortunate trend, especially with most states seeing their fiscal year end on June 30th. The question's still out on income taxes. Many states coupled or delayed payments of those taxes into July, conforming to what the federal government did, both for ease of administration, but that's also to provide more cash back into the economy. So we'll see how this plays out from a fiscal point of view, but I'm pretty confident it's not going to be pretty. We've also seen, because of the sort of the oil war that is going on and demand being down significantly, those states that rely on severance taxes have seen a significant reduction in their tax fiscal revenue as well. So a bit of a double whammy there. NGA, NB, NASBO have been out indicating that Congress needs to act and provide additional funding for the states. And like I said earlier, this may be part of our fourth relief bill. And they're articulating at least $500 billion to the states. Let me just close on my last slide here, which just outlines a number of measures. While the federal government has been acting, we've also seen many states step up and do things, primarily through mandates from their governor's offices. And whether it's delayed in payments, some states are starting to think about how they can stimulate their economy. But one interesting takeaway, these work from home orders that we've seen that have impacted the economy and the business community have also impacted all of your states and how your agencies operate. And it's really highlighted some interesting issues with just collecting and remitting taxes when your Department of Revenue is in a work from home mode. Basic items like thinking about electronic filing, electronic signatures, things of that nature, which, from a business perspective, seem pretty straightforward, but not all states and localities are capable of accepting those types of things. And it's sort of, so how do we sort of stabilize or make sure the revenue streams at the state and local governments can sort of withstand, these types of, pandemics in the future. So we've seen a lot of states really adopt, new work from home rules for their state agencies, and, it'll be interesting if that continues as we hopefully and soon get out of this pandemic. So that's really an overview from a federal level. I know a lot of information. I'm sure there'll be some questions at the end, and I'll hang around to talk about those. And I think from here, we're going to turn it over to Carl, and he's going to dig into some of the TCJA provisions and dig a little deeper into that. Carl?
Yeah, thanks, Scott, and good afternoon to everybody. Pleasure to be here, although under certainly trying circumstances for us all. I want to thank Erlinda and Jackson and the task force for the invitation. If you go to the next slide, what I'm going to try to do is, Scott talked about a lot of significant, we're talking about $2.5–3 trillion of relief to taxpayers, businesses, individuals, state and local government, and so forth. Loans, loan guarantees, grants, and so forth. I'm just going to focus on the three major tax provisions, changes in the CARES Act and the Internal Revenue Code that most significantly affect states. And so what I'm going to try to do is, in 15 minutes, just a high level, but one, what were these provisions? What did they do? Two, show you on each of them maps of 50 state maps showing what the states did or have done in terms of conformity or not conforming. You can look at the maps later, but we'll kind of break it into categories that hopefully be useful. And then third, certainly encourage those states that are not conforming to either what the federal government's doing or what a lot of the states are doing in conforming to the federal government to consider doing so. Obviously, significant fiscal constraints on the states, and these are all, not surprisingly, taxpayer and business favorable changes because they're intended to provide relief for businesses, but certainly something that you should consider that, are really important, at least from the federal and state perspective of many of the states in helping cash flow and liquidity. So what are the three provisions? And interestingly, they're all pretty much rollbacks or in the case of the third one, a technical correction to changes that were made in the Tax Cuts and Job Act. Because if you remember, the Tax Cuts and Job Act at the business level provided a significant corporate tax cut, but in trying to offset that, at least partially, had a number of base broadeners that raised taxes on businesses. And a number of the states didn't pick up the tax cut, of course, but they picked up the base broadeners, raising revenues and corporations. So these are all just temporary, 2 to 3 year, except for the third one, but 2 to 3 year rollbacks of some of these base broadeners or tax increases, specifically targeted things like interest deductions and net operating losses, which are so critical to businesses during this crisis. So the first one, and we'll stay on this slide for a second, but so the first one is modifications to the interest expense deduction. This was one of the key provisions that was put in that, at least in 2017 in the TCJA, limited interest deductions to 30% of adjusted taxable income. And the reason it did so was the federal government was providing, and most of the states did not adopt this, but the federal government provided for 100% bonus depreciation, so immediate expensing of most capital investments for 5 years. When they did so, they didn't want companies to borrow and then be able to deduct that and get sort of a double dip. And so they limited the amount of interest deductions. As I said, most of the states actually adopted this limitation, about 2/3 of them, but very few of them adopted the 100% bonus depreciation. What the Congress has done here is they've changed the 30% limit to 50% limit, making it possible to deduct more interest. And just as importantly, they're allowing businesses that may have losses or much less income in 2020 to use their 2019 adjusted taxable income, which is likely to be much higher for almost every company, to calculate their 2020 interest deduction limitation. So a very favorable provision intended to help companies that are going to probably have to borrow more and more to deduct some of that interest in the short term to help their cash flow. The second provision was having to do with net operating losses. We haven't talked about those in the last decade or so. Great, since we've had such a robust economic recovery, but every recession has, companies, usually 40 or 50% or more. This one maybe even higher, that go into a net operating loss position. And so what this provision did was in the TCJA and another sort of revenue raising measure, the Congress had limited NOLs, so you couldn't carry them back and average them against income and taxes you paid in previous years, and you can only use 80% of your carry forward losses in any given year. For a 2 or 3 year period now, the federal government's reversed that, and they're going to allow carrybacks for 5 years. So if you have losses in 2020 and 2021, even 2019, you can carry those back and offset them against income in previous years and potentially get refunds. And they also got rid of the 80% cap temporarily, which was capping how much NOL carry forward you could use in any given year. The third provision was more sort of industry specific for retail and restaurants, but really there was a widely perceived mistake that was made in the TCJA, where for qualified improvement property, sort of leasehold improvements, they were classified as 39-year property, which meant they couldn't get bonus depreciation, which only applied to property that was 20 years life term or less. And so they've sort of fixed that mistake and qualified this property as 15-year property. So those are the major provisions. One thing before we break down how the states are conforming or not to them, it's important to emphasize here is these are not tax cuts. These are not, sort of loopholes or anything for corporations. These are just timing differences. All of these are deductions that companies get one way or another. It's just a timing of when they get those, but the timing is obviously critical in terms of cash flow and liquidity. So if we turn to the next slide, we're going to dive in quickly into what the states have done on each of them. So this is a map for 163J. So this is a map that shows what the states have done in terms of conforming to the CARES Act change, which gives more flexibility in terms of interest expense deductions. And as you can see, the states in pink here, there's 11 states that never conformed to 163J in the first place, so they're not affected by this. The ones in blue are the ones that did follow the TCA limitations on interest deductions, but because they're rolling conformity states, they are now conforming to these changes, so they have the same position as the federal government does. The ones that are sort of more concerned to the business community, I guess, are the ones in green. These are the states that followed the limitations on interest deductions in the TCJA, but have not updated their code yet. They're fixed state conformity. And so until they do, they won't get the more favorable treatment that the federal government and most of the other states have given. So these are the states that are certainly ones that should look closely at this and see if they want to update their codes to get these provisions that are being adopted by the federal government and most other states. If you go to the next slide, it shows really in each one of these, shows why these provisions are so important and why they were targeted by the federal government in the CARES Act. And, of course, debt just becomes a really, really important thing. And what we've seen over the last 20 years is corporate debt has gone up from about $4.5 trillion to $10 trillion, about its record peacetime levels. And this is statistics back to 2019. This is before the COVID-19 crisis. So you've got corporate debt at almost half of the value of the overall economy. And a lot of this accelerated during and after the last recession as companies borrowed for recovery and expansion at very low interest rates. So when you put on top of that the debt that's likely to be incurred in 2021 by companies just either trying to survive or trying to dig their way out of the economic crisis that we're all facing, you can see how important it is that interest deductions be allowed. And so that's why the federal government and many, if not most of the states have made this change, and why states that haven't done this yet in terms of conforming to the federal change should consider doing so. That's the provision. The next slide shows a map on net operating losses. And this is one where, unlike 163J, most states never adopted the federal changes in the first place. Most states have their own carry forward and carry back rules, particularly because carrybacks can be fiscally expensive. And so most states have decoupled from the historic federal rule that has allowed carrybacks. What happened in the TCJA was that the federal government, again, as a revenue increasing measure to offset the corporate tax cuts that were in the TCJA, limited NOLs They didn't allow carrybacks, which historically they did, where you could take the loss and carry it back in against some recent income years and average out the loss against those income years. They said no carrybacks, only carry forwards, and they put in an 80% cap on what you could do. And now what they've done, as I pointed out before, is that they've gone backwards, as they've almost always do in recessions, and allow carrybacks, 5-year carrybacks, to try to get more cash flow into companies' hands when they really need it. If you look at this map, the states in green are the ones that have unlimited NOL carrybacks following the federal provision or having their own. The ones in yellow are states that have NOL carrybacks, but cap them at a certain dollar amount. And then the ones in red are ones that would have NOL carrybacks, but they're fixed state conformity states. And so they would have to update to the current code to do it. So again, significant differences here between the state and federal position on this, on an extremely important issue in terms of net operating losses. If you go to the next slide, you can see that just as with borrowing, one of the things that happens in an economic crisis is that net operating losses skyrocket, unfortunately. And so rules about carrybacks or caps on using NOLs becomes extremely important to companies when it isn't in normal economic times. And one of the things about this provision is it's very much targeted, because the only companies that benefit from, say, states or federal government having an NOL carryback are those that did really well in the prior years. So they had a lot of income. Now they're doing poorly, in this case, based on totally unforeseen, unprecedented healthcare crisis that was not of their own making. And therefore an NOL carryback allows them to average out their losses in the current year in 2021 against some of the income they made before, and can potentially get them refunds, when they most need the cash flow. And you can see I put down the statistics from the last Great Recession, and those may pale in comparison to this one, unfortunately, but NOLs during that recession nearly tripled from 225 billion a year to 722 billion a year. And I think at that point, about 45% of companies at the heat of the recession had NOLs that they had to deal with. Going to the next slide, and the last provision here, and this one doesn't affect as many industries, and but it is an important provision, certainly for retail and restaurants and a lot of other companies that have leasehold improvements, that they take their existing property and fix it up and then depreciate that over time. And again, this one, unlike the first two, was really more of a, widely conceived of as a mistake. This is just a technical correction, but an important one that makes this type of a property and changes it from the 39 years that it sort of mistakenly was within the TCJA to 15-year property, which then allows it to qualify for bonus depreciation. Again, you see wide variation in terms of what the states have done on this one. The states that are in pink conform fully to the federal bonus depreciation and to these new changes to the qualified improvement property. The ones in green and blue are ones that don't conform to federal bonus depreciation. Again, this is one that historically a lot of states have never followed, first the 50% and now the 100% bonus depreciation, frankly, because it costs money. It's a revenue loser, so they've decoupled from it. But there is some concern here, and look at your states individually. The states that are in blue are ones that didn't couple to bonus depreciation, but are coupled to this sort of older, almost mistaken rule that this type of a property, which is critical to certain industries, is now classified as 39 years. And so until they update to the code, they don't pick up the change to the 15-year qualified improvement property. So those three are the major provisions. I just want to finish with, if you go to the next slide, just with a couple final comments on it that are, we're all in a mess here, business and government. And so the states are in a very unenviable, precarious fiscal situation where they may have to balance over the next couple of years, as they often do in recessions, two very conflicting priorities. One is balancing their own budgets, as you all know, in the face of sharply declining revenues. And the second one is providing businesses and individuals, with tax or other financial relief to help them cope with these, mandatory shutdowns, slowdowns, and so forth. So if you go to the last slide, you know, given that duality and the, you know, certainly no one pretends this is easy and there's a lot of difficult choices that have to be made, but wanted to bring up these three provisions, both because they were the most important changes from a tax code perspective in the federal code within the CARES Act that impact states. And none of them, again, they're all timing differences. They're not corporate tax rate cuts or any other, you know, sort of relief for corporations. They're just deductions that they would get eventually, but getting them sooner is of extreme importance, you know, particularly on the NOLs and on the interest expense deductions, and certainly encourage states when they look at the map. You know, the reason the federal government targeted these was precisely because they felt they were important, and that administratively also they're very straightforward, unlike the SBA and other programs that are, you know, obviously struggling to deal with the onslaught of applications and so forth. These require no applications. They're simply provisions that, you know, you file your corporate tax return or your amended return and you can get them. And I put a site there where one of my colleagues and I co-authored an article on this last week that's in State Tax Notes if you want to see more detail on these. So again, like Scott, be glad to answer questions later, but I'm going to turn it over at this point to the next speaker.
Thank you, Carl. This is Richard Graham with the Multi-State Tax Commission. It's a pleasure to join everybody on this distinguished panel of the NCSL SOLVE Task Force. I'll talk about the some impacts of the CARES Act on a couple of the features that Scott talked about, and then I'll also get in briefly to some nexus issues that have been created by the change to teleworking patterns that businesses have experienced as a result of state emergency declarations and stay-home orders. Next slide, please. Scott talked about the loans under the Payment Protection Program, and those are available to small businesses, nonprofits, etc. They are forgivable, assuming the business maintains its payroll. These loans are intended to cover payroll costs, utilities, rent, mortgage, as Scott mentioned. But if the payroll is maintained the way it was, then for the 8 weeks following the loan origination, then that loan can be forgiven. Traditionally, under federal income tax law, loan forgiveness is considered part of income, which is potentially taxable. The CARES Act has an express provision in it, though, that states that loan forgiveness from the Payment Protection Program is excluded from gross income for federal income tax purposes. Now the question is, how does that translate at the state level? And so that will depend on what Carl talked about, whether the state conforms to the federal income tax code and the CARES Act, and whether it does so on a rolling basis or a static basis. Very few states have published any guidance on this. I just saw, I think today, that Hawaii Department of Taxation published release number 2020-02, where they indicate that under Hawaiian income tax law, the loan forgiveness income under the Payment Protection Program is considered taxable for income tax purposes. The Revenue Department is going to recommend to the legislature that an exemption be enacted for that. Also, they stated that this loan forgiveness income will not be subject to general excise tax. But be good if a lot of additional states will publish guidance on what the state level income tax treatment is going to be for loan forgiveness income. So we'll see what happens with that. Next slide, please. Another part of this is, well, what about the business expenses that were incurred and then paid for with payment protection loan proceeds that were eventually forgiven? Is the business still going to be able to claim those as a federal tax business expense deduction or not. If they were allowed to do that, that would appear to give them essentially a double deduction. The loan forgiveness income would be forgiven, and in addition, they could claim those same expenses that were covered with the forgiven loan proceeds as a business deduction. The Internal Revenue Code provides under Section 265 that if you can't take an expense deduction for what's considered exempt income. And I think just yesterday, the IRS published Notice 2020-32, which does state that under Internal Revenue Code Section 265, you can't deduct those expenses. So you're going to get at the federal level, you'll get that loan forgiveness income as excluded from gross income, but you will not be able to claim a deduction on your federal return for business expenses that were covered by those loan proceeds. That's probably going to take care of this issue at the state level, but I think it still would be helpful if states would publish guidance on this. And again, it's going to sort of depend on whether the state conforms to the CARES Act provisions in the federal income tax code. Next slide. Another aspect of the CARES Act that Scott mentioned were the stimulus payments to individuals. This was going to be at $1,200 per individual, $2,400 per those filing married jointly, and I think $500 per child, subject to certain income limits. And everybody's been asking, well, is that considered? First question, is that subject to federal income tax? Answer that pretty clearly, no. As Scott mentioned, it's considered a federal income tax rebate of 2020 taxes, and even if it's refundable, taxpayer doesn't have income tax liability. It's still going to not going to be considered taxable at the federal level. The state level treatment, though, is going to depend on whether the state provides in essence, an itemized deduction for federal income tax paid. If they do, then the stimulus payment could play into that, as it's it's a reduction of your federal income taxes. So that in turn would reduce your deduction that you could claim against your state taxes. So it'll depend. Unless the state, most states probably they'll start with federal adjusted gross income in determining state income tax, and they may have their own sort of itemized deductions. It doesn't include federal income tax liability, but for those states that do, it would be helpful to get guidance on how they're going to treat that. Several states have published guidance. I've got them listed there below. Arkansas actually enacted legislation, House Bill 2083, which expressly provides that these stimulus payments are not going to be taxable by the state. I think Missouri has introduced legislation that would expressly make these stimulus payments not taxable. And then you can see the other states listed there. Next slide. Another kind of small feature of the CARES Act was that it provides what's called an above the line charitable contribution deduction to individual income taxpayers who claim the standard deduction and don't itemize. Normally, the only way you can claim charitable deductions on your federal return is if you're itemizing. So this is new, giving standard deduction people who claim the standard deduction a new deduction, and this is pre-AGI, pre-adjusted gross income. So it comes off the top. They get a maximum of $300 deduction for charitable contributions just for tax year 2020. This is going to impact states and their revenues from individual income tax to that extent. probably not near as huge as the other things the states are dealing with, but it does need to be taken into account. And next slide. Now, I mentioned the nexus issues relating to stay-home orders and emergency declarations by the states that would prevent someone who would require people to telework at home rather than go into their business location. And this comes into play particularly in states in large metropolitan areas, or where you've got a lot of folks from one state working in the other and vice versa. And so particularly like in your in the northeast corridor, some states that may not have large population centers on the state borders, it may not come into play so much. But the question would be, is a state going to claim that a business has nexus simply because they've now got teleworkers from that business who are working at home now, and therefore giving a presence in the state through those teleworkers, versus prior to the COVID-19 pandemic, they were commuting to their out-of-state business employer's location. And it looks like there's two approaches developing on this. You can see those states there at the top in the District of Columbia, Indiana, Massachusetts, Minnesota, Mississippi, New Jersey, North Dakota, Pennsylvania, and the city of Philadelphia. They've stated basically that we're going to ignore the changes taking place with teleworking patterns. And if you were in terms of corporate income tax nexus, so in other words, if you're a business located in New Jersey and you've got employees that are commuting into New York, New Jersey is, or vice versa, New Jersey is going to ignore the fact that those employees that were working in New York are now working in New Jersey, and also that if they've got New York employees coming into New Jersey, they're going to ignore that for corporate income tax nexus purposes during the emergency declaration period. Now the question remains, what's going to happen after that emergency declaration period expires? But these guidance that states have published only deal with the situation during the pandemic emergency declaration time period. Ohio passed legislation where they indicate that teleworker presence that's as a result of stay-home orders isn't going to count toward their 20-day threshold for municipal income tax. And Maryland is taking a different approach. They're saying we're just simply going to apply our existing nexus rules. So if you're a out-of-state business that has Maryland residents who are working at your out-of-state location, and they're now working in Maryland, that could result in nexus in Maryland now. So, but those are kind of the two approaches. One is to essentially ignore the changes caused by the telework patterns as a result of stay-home orders. The other approach is to say, well, we're just going to apply our current rules to that. Let's see, and next slide. This also plays into corporate income tax apportionment. We've got the three-factor formula: payroll, sales, property. So for the payroll factor, it's generally the what's your payroll in the state versus everywhere else. And if you've got now you've got either people who were working in your location, now they're working at home, and vice versa, that's going to change, could change your payroll factor numerator. So many of those same states that said they were going to ignore this teleworking pattern change during the emergency declaration period for corporate income tax nexus purposes, they're also going to do the same thing in terms of the payroll factor numerator. The business is not going to have to change their numerator if their employees are working from home simply because of stay-home orders. And Maryland likewise is following the same pattern they did with corporate income tax nexus. They're saying, well, we're just going to apply our current rules. So if you've got more payroll in Maryland now as a result of the stay-home order, that just needs to go into your apportionment factor for the current tax year. Okay, and next slide. A few of the states have also provided guidance on sales and use tax nexus aspects. Of course, we have, as a result of the waiver decision, we have economic nexus, but that didn't do away with physical presence nexus. So that has to be considered. Pennsylvania, Minnesota, and Pennsylvania have indicated that they're going to not consider physical presence as a result of stay-home orders to create nexus. And last slide. Yeah, next slide. And then finally, just to finish up, also has impacts to employer withholding requirements. Again, you've kind of got two different approaches. Massachusetts, Mississippi, New Jersey, they've said we're going to not require employers to change their employer withholding patterns as a result of stay-home orders. Maryland and Minnesota, they have both indicated that, well, we're just going to apply our current withholding rules, and whatever change occurs as a result of stay-home orders, that's just the way it is. And that's going to conclude my remarks, so I'll turn it back to Erlinda.
Great, thank you so much, friends. We're going to do some Q&A now, and if we can just, Jocelyn's going to man the chat box here, and if you could just type your questions into the box, that'd be great, and let's do that.
Hi, I have the first question. I received a call from a constituent who reports that he qualified and received $120,000 in PPP, but his accountant advised him that his federal tax liability on the funds will be $40,000. Can you comment on this?
Geez, Jocelyn, this is Scott Roberti. It's probably one of those we'll just take offline. It's hard to answer personal tax questions with very limited information. So.
Okay. The next question is, hasn't the second round of PPP run out already?
I haven't heard that it's been completely run out. I know there's been discussions along with sort of another round of stimulus for the states on refunding it. There's also, I'm sure folks have read the paper, there's some light shined on who's receiving those funds. So I have not heard that it's run out of funding yet with regard to the second round.
The next question is, are revenue impacts different in states that rely on sales tax versus income tax?
Yeah, so I think just on some initial data, right, we're starting to see some states get, some 1 month and 2 month, data in now. But so if you're a sales tax state, we saw in the states that we've looked at a very significant drop in revenue with the government shutdown. Most of our economy is driven by consumer spending. But I would also say on the income tax side, because many taxpayers have taken advantage of delaying their payments with regard to personal income taxes and corporate taxes, we've seen those states sort of equally hurt. How this plays out in 6 months or so is to be determined. There are, like I said, a number of ways to model this, But where will states be? States that rely more on sales taxes, will they be hurt more? I think it all depends on how quickly the consumer economy comes back. And then sort of income taxes typically have a tail to them as compared to sales taxes. So we may not see the full impact sort of a recession on income taxes until a year later.
If you rely on corporate taxes, the impact is a lot worse next fiscal year. I think that's
Yeah,
just
so that's the delay factor, right? That's the delay factor of, so companies are, filing their 2019 tax returns, now or using the extended due dates, and making estimated payments. And some states, those have been delayed as well. So their 2020 tax returns, they'll make estimated payments this year, but they won't file those actual returns until 2021. So yeah, there's always a delay factor with regard to any sort of income tax.
if your state taxes the PPP as income, would expenses paid by the PPP be deductible if those expenses are normally deductible under your code?
Richard, do you want to take that one?
I would think it'd only be fair. It wouldn't make sense if they're going to tax the income, you ought to get the deduction. So that'd be my thought as to what the answer is. What the actual answer is by the states, I think we'll have to see what they say.
I like that, a fairness argument. That's fantastic.
Those are all the questions for now.
If anybody would just like to verbally ask a question and unmute yourself, I think that's okay. Please go ahead, or any sort of any other insight or anything you'd like to add to our discussions, please feel free.
I guess I have a quick question for Linda. Is there, so you mentioned that the forgiven portions of the PP loans are not taxable. Is there a concern that forgiveness might not be as readily granted as businesses might expect?
Well, it depends what they use those funds for, Jackson, right? So they have to use those funds for payroll, mortgage, rent. I think it's utilities. So if the loan is used for something other than that, then as I understand, the forgiveness element doesn't exist, so therefore it'd be taxable.
Looks like we have another question. Can we expect state tax departments to become more aggressive as revenue becomes more important?
So, Carl, do you want to answer that? And I'll come back in with my thoughts as well.
Yeah, I mean, I think that's going to kind of cut both ways. I mean, I think states are going to be sensitive to, the perils of the businesses and individuals in the circumstances. And, kudos to the states for generally following what the federal government has done in terms of delays on filing deadlines and also on payment deadlines, which are really costing the states in the short term. On the other hand, there's going to be both, the next, 6 to 18 months of relief measures and things to get us all out of this mess. And then there's going to be revenue raising over time, certainly at the federal level, to try to, pay back, some of those loans and so forth. So I think the answer is it's going to cut both ways. No easy way to do it, but hopefully, certainly in the short term, as a lot of the, maybe not all of them, but a lot of the states have been also delaying certain things in terms of court litigation and so forth to provide flexibility for taxpayers who can't get into their offices and so forth. So one would hope that you would see a lot of flexibility in the next 12 to 18 months, and then maybe that'll shift over time. Any thoughts, Scott?
Yeah, it's really an interesting question, because as I sort of stated earlier on, these work from home provisions have really impacted how revenue agencies can operate. And at the end of the day, taxpayers need some certainty and predictability, especially with all these provisions from the federal government. So to answer the question a bit more broadly, we're encouraged by some Department of Revenues that have been able to sort of work from home, work remotely, sort of move through their, what I would say, traditional, duties. We have a number of clients that are looking for that. Look, do we see, we've seen it before. States have provided, amnesty programs during times of recession or times of coming out of recession to generate, more revenue to try to accelerate, tax collections. And I'm pretty confident we'll see, more of that, come later this year when states come back in a session or in 2021.
Yeah, and I think there's a just last comment, there's the sort of tax administration side of that, and then there's the tax policy side of that, which is what most of the people on the line here, I think, are dealing on the tax policy side. And, again, going back to the subject that I covered, there's going to be just really difficult choices the states are going to have to make here in terms of balancing their own budgets, but also helping the businesses within their states. And that's why I certainly encourage the states to look closely at those two primary issues, really, losses, net operating losses, what you can do with them, and also interest deductions, because those are both of crucial importance to business in their state. And the sooner businesses recover, then obviously the sooner state revenues recover to their normal levels. And tough trade-offs there, but the federal government is shown flexibility there, and more taxpayer-favorable provisions for the next couple of years, as have a plurality to a majority of the states on each of the things I talked about. So other states should certainly seriously look at that and look at what the trade-offs involved are in conforming to the federal rules.
Yeah, this is Richard. I would just add, I think, that right now the states are trying to kind of bend over backward to accommodate taxpayers, granting extensions, extending deadlines. They realize that, the businesses have to survive in order to have generate tax revenue in the future. So certainly in the short term, that's going to be the focus.
So this is Veranda with Federation of Tax Administrators. As long as you have a tax administrator in the chat room,
Hello, Veranda.
Hey there, everybody. Just wanted to add that you will never see a tax agency have better enforcement except during the times when it has money and it doesn't have money going forward. So actually, I expect to be some hard thinking on where this tax agencies are putting their enforcement dollars over the next fiscal year or two. With everybody has been talking about how much the states are bending over backwards to accommodate these weird times that we live in. I expect that to continue. I don't see any way, even if you didn't agree that their hearts are in the right place, as a matter of reality, I don't see any way a tax agency could have more enforcement going forward than it's had in the last 3 years. It's not going to have as many people. Those people are going to be doing more tasks. It is going to be catching up from the work that hasn't been done or that has been done in weird ways over the last few months. They will keep their eye on where the critical activities are, but I wouldn't be looking for them to scrape up every last dollar based on the back of enforcement. Enforced collections are a relatively small percentage of where the tax revenues come from. So you don't look there first when you're trying to make up dollars. It's the legislature's place to make up the dollars. Tax agency is supposed to collect what's due and stop. And boy, are you right about the amnesties. We don't love them. That's an understatement.
Right.
But it's cash flow issue. And with as much collections that have been halted in recent months, I can see the attraction.
Yeah.
All right, looks like we have some more questions. From a tax enforcement standpoint, does it make more sense to include the forgiven portion of PPP aid in taxable income than to have potential disputes about matching expenses to the exempt PPP portion?
I don't know, Richard, do you have a point of view on that?
Oh, I guess my thought would be it's going to be a complicated area either way.
I agree with that.
Where traditionally loan forgiveness income is taxable, it's now you've got now an exclusion for this one particular type of a loan. I think it's going to present some challenges at both the federal and state level.
Yeah, I mean, you'd, I guess one comment on that, you'd hope, because it usually is when you give it, it usually comes into income, but I think federally, that's not going to be the case with the PPP, and you'd hope that the states would conform to the more, generous provision at the federal level that's aimed at helping small businesses, so that if they're getting this new money as cash flow and they're getting loans forgiven, that not also then be taxed at the state level, but we'll see what happens.
Okay, 2 more questions. At what point will policymakers have some clarity about revenue impacts for fiscal year 21?
Clarity is sort of, I guess, in the eye of the beholder, right? We're seeing models starting to come out from some of the states, either ones that they've done themselves or they've worked with, third parties to develop. Look, I think it all depends on how the states that are closed right now open back up over the next, 2 to 3 months. I'd say we're probably looking, sometime, mid to late summer to see something of that nature, to get some clarity. I know that's not helpful, right? Many states have a fiscal year end that's approaching in the next 2 months. And those are some very tough discussions. Rainy day funds are going to be quickly exhausted. And then sort of where does that lead states going into their next fiscal year? So sorry for the sort of not clear answer, but I think right now we're relying on modeling and trying to see how, opening up the economy and, how quickly do people get back to leading some sense of normalcy and so forth, traveling, going to restaurants, things of that nature.
Yeah, I mean, just one other observation, I think one of the sort of elephant in the room, perhaps, for state and local government is the next round of financing or fiscal aid from the federal government. And I think probably state and local government and most businesses share a common interest there, that the state and local governments desperately need more money, given sort of the unprecedented nature of some of the deficits they're going to face. On the other hand, if businesses are going to get some targeted relief at the state level, which I think they need, not just the federal level, they're going to need federal government to help out the state and local governments as well. So that's obviously front of mind for NCSL and a lot of others, is what's going to happen in the next round of funding. Is there going to be additional hundreds of billions for state and local government as well?
Thank you. This is the final question. To provide relief to individual and corporate property taxpayers, what do you suggest in the form of tax reductions as states are moving forward in the next few years?
I think, Erlinda, isn't there going to be more discussion on property taxes next week?
Yes, actually, a lot of these questions we can take up in the next couple sessions. For instance, our next session is going to be state tax administration and compliance. So we'll be discussing some of those issues there. And then finally, revitalizing tax revenue streams and basis will be our final panel. So we will definitely be tackling some of these larger issues at that point. So if we can hold off a little bit on some of those, or we can just take this last question and we can, be done now, I think, because we were basically blocked until the quarter after the hour. So,
Erlinda,
Yeah.
let me
Yes.
weigh in on that property
Yeah.
tax issue. There are states like Utah where property tax is in the Constitution. And so the legislature can't come in and say, we're going to waive property taxes because it's a constitutional issue. And most property taxes are imposed by the individual political subdivisions in Utah. The actual rate of taxes are imposed at the local level, not at the state level. So it would be very difficult. The question is, are property taxes going to be reduced or whatever, like we can do with income tax or sales tax? In many states, that may be a constitutional issue, which is different than statutory on taxes.
Yeah, and just one other thing is I know COST and a number of other organizations have been working on the filing deadline issue and payment issue, leaving aside how much is owed. It's much harder to coordinate that, as the states have coordinated with the federal filing deadlines, most of them moving back to July 15th. But there's really been a push at the county and local level to try to get localities to use similar flexibility, pushing back filing deadlines 30 days or 60 days or whatever, to do the same thing that's happening on income taxes and to some degree on sales taxes, because that's really important. That doesn't affect how much is due, but when it's due.
great. I think that about covers it for the time that we have set aside today, friends. So yes, thank you so much for joining us today. Again, our next 2 sessions will be the next 2 following Fridays. Same time, as you can see here, state tax administration and compliance. And then finally, the revitalizing state revenue streams, which I know will be very interesting to all of our members and sponsors here. So thank you again, and we will be posting, and again, thank you to all of our sponsors. We have them listed here. Appreciate everyone again for all of your support and continue to support the SALT Task Force as we move forward. We should also have a little bit more clarity next week, if not right after then, regarding our meetings that we'd planned for the rest of the year. I know, we're still sort of reviewing and paying close attention to the guidelines for various states as to where, and what the safe, requirements are to have meetings. So we'll be updating you folks on that as well as we move forward for the rest of the year. So thank you again, and looking forward to seeing all of you again next week. And if you have any further questions, please feel free to email either Jocelyn or myself or Jackson, and we will do our best to share the information. Thank you very much.